The coffee, take your seats. Good morning, everyone, and welcome to our full day of the conference on monetary policy transmission to developing economies. So we are going to have 3 sessions this morning. We'll have 2 with the theme of banking, 2 on the theme of dollarization and other implementation challenges, and then another 2 papers on monetary policy frameworks. And it is my duty, my honor, to introduce the first session on that deals with banking system issues. So we have 2 speakers. First, there's Camelia Minoiu, who is an economist at the financial markets team at the Federal Reserve Bank of Atlanta. She had been at the Federal Reserve Board prior to that time. She got a PhD from Columbia University, and she studied at the LSE. She has a bunch of papers. I'm not going to try to summarize them all, but probably the one that's most salient from the standpoint of this conference is something she had a few years ago from the Journal of Development Economics on monetary policy and bank lending in developing countries, loan applications, rates, and real effects. But she has a bunch of other papers too. Another one that I'm sure many of you would be interested in if you had a chance to read or talk to her about it is one on microcredit. So that's but a lot of other papers. As I said, I'm not going to go through the whole CV. Our second speaker in this section is, we're happy to welcome Santiago Camara back to Williams. He is familiar. There he is. He's familiar with Williams intimately. He's currently at McGill University. Too bad, having earned his PhD at Northwestern University. We should all give a congratulations to Santiago. He has a paper that was just accepted at GIE. So way to go. That paper is, let's see, what's it called? It's called Spillovers of U.S. Interest Rates, Monetary Policy, and Information Effects. So way to go. He's also doing some very interesting work from the standpoint of all of you here on sterilized foreign exchange intervention and another topic of great interest in his paper on borrowing constraints in emerging markets. So lots of really relevant stuff. We're looking forward to seeing your research coming out in the years to come. So those are our 2 speakers this morning. Each speaker is going to have about 30 minutes to present, then we'll leave about 15 minutes or so for questions and answers. I think that's it. Take it away, Camelia. And I'll be down there with the timing signs.
Please, absolutely. Well, thank you so much. I'm really privileged and honored to be here. Thank you for the invitation. So today I will speak about the bank lending channel in Uganda. And I do want to give you a little bit of background on this work. How did it come about? So my first 10 years after graduate school, I spent at the IMF, and I really wanted to move to the research department. And so I spent quite a bit of time in the African department and then in the Institute for Capacity Development. And when I interviewed for the research department, in particular the development macro section, my future boss at that time said, I would really love it if you applied your applied micro skills to a question that has been bothering us for a while. We want to know more about the bank lending channel of monetary policy in developing countries. And I said, I will investigate this question, but can I have free hand as to how I'm going to approach it? And the reason why I wanted to have free hand, so to speak, like complete academic freedom, was because much of the literature had been focused on VARs and macro time series, and I wanted to bring microdata to the question. And my boss said, absolutely, you go for it. And so this is how this project was born. It was born out of sheer luck. I happened to be the right person at the right time to ask this question, but also an incredible openness and willingness to engage with us on this question from the Financial Stability Department at the Central Bank of Uganda. Charles Abuka was the head of financial stability, and Ronnie Alinda was a research associate in the department. And they provided the data and provided most of the knowledge and expertise on how to approach the question. And then I partnered up with Andrea Presbitero, who is still at the IMF, a very, very good friend of mine, and Jose Luis Pedro. And I'm going to come back to Pedro as a co-author on this project because he's the one who sort of revolutionized the way we think about answering macro questions with microdata. And I have a disclaimer. The usual disclaimer applies. The views are my own. So let's see. Oops. Okay, perfect. So let me motivate this work with 2 quick quotes from leading thought leaders in the field, this is just to set the stage. We know these things, so there's a lot of weakness in what we find the monetary policy transmission channels to be in low-income countries, as reflected in Stanley Fisher's remarks at the African Central Banker Roundtable, where he said, in many developing countries, interbank markets are still underdeveloped. So there's this idea of underdeveloped financial markets, equity, bond markets, which means underdeveloped or non-functional asset valuation channel of monetary policy, even though some central banks use policy rates, and changes to these policy rates only have limited effect on other interest rates or on the economy more generally. We will see that in the case of Uganda, there's pretty strong transmission from the policy rate to short-term interbank rates and even short-term treasury market rates. So this is reflecting the weakness of the underdevelopment of financial markets as an impediment to monetary policy transmission. And then Olivier Blanchard picks up on the one channel that should be working, if anything, in developing countries, which is the banking channel. He argues the role of banking, both its existence and governance, seem essential to understanding how, for example, monetary policy is transmitted to the economy. Even so, banking systems in developing countries and some advanced economies tend to be very concentrated. And so because of that, we believe monetary policy transmission is impaired, because with banks having a lot of market power and segmented credit markets, it's the net interest margins, it's the profit margins of banks that will absorb interest rate changes. So there will be adjustment on the deposit rates, but not so much on the lending rates. The lending rates tend to be stickier. And this is also related to another argument, which is that financial intermediation is very costly for legal reasons, institutional reasons in developing countries. So with all this in mind, I'm going to focus on the one channel that we think should work. It's the bank lending channel. And we're going to throw a lot of microdata at this question in the context of Uganda. So the research question will be to study the loan supply, bank loan supply, and the real effects of the bank lending channel of monetary policy. We will focus on a particular episode, 2010-2014, where we have wild variation in nominal and real interest rates as the Central Bank of Uganda attempts to bring inflation down into single-digit territory. And so we relate this work to studies based on aggregate data that I mentioned a bit earlier and very expertly summarized. I mean, this is a huge literature. We are very complementary to this literature. Professor Montiel, Prachi Mishra, our colleague from the IMF, have beautiful papers that summarize the knowledge of bank lending channel evidence in developing economies. That evidence is somewhat weak. And we complement that evidence with somewhat stronger effects, which we think arise from the fact that we are able to dig into microdata. We focus on the bank lending channel because banks are the main source of external finance for firms. They are critical for economic growth. So understanding how they respond to interest rate policy is very important. And finally, we kind of piggyback on what I would call a revolution in empirical macro, which is the use of administrative microdata, in particular credit registry data, that was pioneered by two papers in the AER and Econometrica from Jimenez et al. So Jimenez was the chief of financial stability supervisory department in the Bank of Spain, and he partnered up, he and colleagues at the Bank of Spain partnered up with academics in Europe to reevaluate the bank lending channel of monetary policy in Europe, in the Eurozone. And they have two papers that were extremely influential, and they kind of set the stage for an entire literature. I am very proud to say that so that's kind of the source of us partnering up with Jose Luis Pedro, who was a co-author to those papers and one of these pioneers in this literature. And I'm very proud to say that this was the first paper to examine the question of the bank lending channel using a credit registry from a developing country, from an African nation. And so we were very, very proud, very happy about this. So it was quite innovative for that time. So our contributions will be to use administrative credit registry data, loan level data, to be very careful in how we identify the bank lending channel. So the bank lending channel is about the supply of credit, how the supply of credit changes in response to interest rate policy, changes in the policy rate, as reflected hopefully in short-term market rates. And the problem with this identification is that interest rates will affect not only the bank lending, the bank credit supply channel, but also the firm borrowing channel. So firm borrowing will also, the demand for credit will also shift in response to interest rate changes. And we want to focus on isolating supply. And so it will not be easy. This is very difficult in practice. How do you control for demand, which is unobserved? Typically, people will use survey data or some other proxies like aggregate growth, GDP growth. But we're going to use an identification strategy that allows us to hopefully more credibly control for or isolate credit demand from credit supply effects. We will examine both the intensive and extensive margins of credit supply, and that's because the credit registry of Uganda is very, very rich, much richer than in many advanced economies. We observe not only all applications for credit with yes/no decisions, but we also, for approved loans, we observe the lending terms, so the volume and the interest rate. So we can look both at the extensive margin, are you getting a loan when you ask for it as interest rates change, and the intensive margin, what happens to volumes and interest rates, lending rates as interest rates, policy rates change. And so this will allow us to have quite a comprehensive view, both intensive and extensive margins of lending. We know extensive margin of lending is extremely important for banks. Banks will just ration credit. If interest rates are too high, they will just ration credit. You will see that only if you have data on loan applications. And like I said, I think in Europe, well, I hope I'm not mistaken, but only Spain has information on loan applications. In the US, we don't have. We only have data on approved loans. So just to illustrate how rich this data is, and my hope will be that this data continues to be used, and I would encourage many of you to exploit the incredible sources of data that are sitting in central banks, mostly thanks to financial stability functions and the collection of data for supervisory and regulatory purposes. And then we examine the real effects. Here we bring together a lot of information on the real economy because we want, within local administrative units, we want to see kind of control for general equilibrium effects. And so we'll have data on commercial building permits. This is truly available across countries. And most of the time it's public data. On exports, absolutely incredibly detailed data, so detailed that our referees at the Journal of Development Economics could not believe that we have such data. The data is at the province for all the firms that are exporting. We know where they are located. So at the province or district, export product for 80 products, destination country and time level. So that means that we can control for demand shocks from destination countries at the product destination country level. Super detailed. Industrial production locally, we do not have. So we approximate it, and we do that for the US as well, with nighttime luminosity collected from satellites. This data is super high frequency and is very detailed. You can see longitude, latitude, so you can aggregate it at the administrative level. We even have data on public demonstrations because the high prices and then the incredible ratcheting of interest rates led to social unrest in Uganda. So we see that reflected in sort of like public demonstrations and a little bit of social unrest. And we also look at the impact on inflation. So I want to just give you a little bit of background, and then I'm going to come back to the picture. So the background for Uganda is, in terms of monetary policy framework, around the period we look at, which is 2010-2014, Uganda was in transition towards an inflation targeting framework. So previously it had sort of backward-looking monetary aggregate targeting. It was estimating money demand, and because of financial development and people using like apps for money transfers and just technological development in payment systems, it was observed that money demand and inflation, that the relationship was not so stable over time. Money targeting was also associated with like very volatile inflation. So they engaged in a transition to an inflation targeting regime. At the time when we analyze monetary policy in Uganda. They had just adopted in July 2011 inflation targeting light. So that is a regime where you kind of give yourself a little bit of time to implement the structural reforms needed for credibility once you announce a nominal anchor. It did announce a 5% nominal anchor, and the idea here was to bring down inflation from double digit to single digits. Now, with the implementation of the IT light regime, they created a policy rate with which they were guiding short-term interbank rates through open market operations in the secondary treasury bill market, government securities market. And our measure of monetary policy will be the 7-day interbank rate. And importantly, this rate co-moves very strongly with short-term, the 3-month treasury bill rate. Also importantly, over the period we analyze, there are no significant changes in macroprudential policies. There's only one macro-pru tool that they were using from time to time, which were reserve requirements. There's no change. So I'm saying all this because it's important whenever we analyze the impact of policies, few of which are true shocks. We have to be mindful of what else is happening in the economy. That's why, you know, all the COVID policy intervention papers that you read, take with a grain of salt. Many things are happening during the COVID period. It's a policy-rich period. So disentangling and identifying the effects of particular policies is always fraught with problems. So we have to be very, very mindful and keep that in mind always as we interpret the results of papers. So now let me go back to this picture. What we have here is credit aggregate credit growth. So this is corporate credit growth in % year on year. And superimposed, we have the 7-day interbank rate. We see the policy rate also, the dashed line, which is implemented, is sort of enacted for the first time in July 2011. And so what's happening here in the background is that Uganda receives a massive commodity price shock. Inflation soars. And so inflation soars kind of at the same time with credit aggregates growing. So the economy is growing, inflation is high. There's a little bit of sort of overheating, if you will, in the economy. And what happens is the Central Bank of Uganda decides to tighten, and it tightens absolutely remarkably much. Now, you may say, well, all of this is endogenous to what happens in the economy, right? The tightening is endogenous. So how are we going to disentangle all that? So we're going to argue that the tightening is very large, maybe larger than people expected. The timing is also unexpected. But of course, identifying the shock or surprise element of this tightening is extremely difficult. We're going to control for GDP growth, and inflation lagged. And I'm going to argue that this tightening was very, very largely unanticipated in terms of its extent and timing. So the tightening happens, we see credit growth collapse. And then we see then that the red line comes down, the policy line and the policy rate and 7-day interbank rate, they both come down. So the Central Bank of Uganda eases when they realize that the tightening may have sort of been overdone. And we see that the recovery is extremely sluggish. So very strong asymmetric effects of monetary policy, much easier to kill an economy than to make it raise from the ashes again. Yeah, so pushing on a string kind of argument, very, very difficult to, once you've brought the economy down, to resurrect it. So this picture gives the entire story of the paper. We're going to exploit this incredible increase by a total of 1,000 basis points between July and November 2011, and then the cut in the policy rate by 1,200 basis points cumulative between February 2012 and March 2013. So tightening over half a year, easing a little bit more gradual over the subsequent year. And these interest rate variations that I've shown here are just historically huge. They are in the top 5% of the distribution of interest rate changes announced by central banks in developing countries since 1980. So huge movement. We're going to exploit this variation together with our microdata. So Jovine, whom I met at dinner, and there she is, you're gonna be my fact checker. Yeah, so do not let me get away with anything that might not be true. The banking system had 25 banks, mostly foreign banks and privately owned, nevertheless not so integrated with the global financial system, so somewhat insulated because they are locally funded. So unlike Shebnem's presentation yesterday, here we don't have that short-term wedge that she highlighted because we have a fairly sort of closed financial system. Total banking assets, 20% of GDP. Like in many other countries, the high degree of concentration, the largest 5 banks hold 73% of assets. In the US, the largest 40 banks of 4,500 banks hold 75% of total assets, very concentrated banking system as well, which is why the deposit channel of monetary policy is very powerful in the US as well. And so if that so this argument has been used again to explain why there may be weak transmission, because if the banks have a lot of market power, they're going to just adjust. They're not going to have to adjust lending rates much in response to interest rate policy. Also, importantly, banks are very highly capitalized and liquid. So having seen the re-regulation of the US financial system since the global financial crisis and all the discussions around that with Basel III, et cetera, to see such high capital ratios is always like, wow, in developing and emerging markets, because, capital is sort of like fraught with a lot of discussions. How much capital should banks hold? They're very, very highly capitalized and liquid because they hold a lot of government securities. Again, unlike, for instance, the US, where the holdings of government securities by banks are very, very small. So let me then go to the empirical strategy. So the empirical strategy, I've mentioned already, monetary policy is endogenous to economic conditions. It responds to growth. It responds to inflation. So there's this reverse causality that makes empirical identification hard. And the way we're going to deal with it is, again, to use this somewhat unanticipated shock that we believe it contains a surprise element. We're not going to quantify it. We don't have high frequency futures or anything like that to do monetary policy shock identification, but we use a narrative approach to tell the story. And so how do we tell the story? Why do we think of this as a natural experiment? It's because the Bank of Uganda had a pretty dovish track record before this episode. They had been hit, like many other low-income countries, by a commodity price shock just before the global financial crisis, around 2008. And at that time, they had not reacted. So they seem to be kind of willing to allow monetary policy to be accommodative. In some communications, they actually had said that we're willing to stay accommodative as long as growth is broad-based. Yeah. And they had limited communication in regards to the intermediate inflation trajectory once IT was adopted. That communication only came late in October 2011, so way after they started tightening. You read the media, you read the economic commentary, there's just no discussion of the central bank having to tighten or agents expecting it to tighten. If anything, around this time, the communications are all about, relieving supply side bottlenecks and, doing more to support growth as opposed to fighting inflation. So based on this narrative approach, we believe that we are identifying something of a natural experiment here. And then finally, we'll control for shifts in credit demand. I'm going to show you the regressions with very granular interactive fixed effects. For every single firm that borrows from 2 banks, we are going to ask how those banks lend, to what extent they lend differentially if they have different levels of capital or liquidity. And when we don't have that granular, that much multiple bank borrowing, we're going to aggregate the data at the district industry time level, which means that with these fixed effects, we control for demand shocks and other unobserved shocks for all firms in the same district and industry. So the credit registry data comes from the Ugandan Credit Reference Bureau. We have loan applications and granted loans, 2 separate data sets. And we focus on local currency loans. So the economy is partly dollarized. A lot of the evidence goes through for Forex lending. So we don't see substitution away from LCU to Forex lending. We have a little bit of data on borrowers, location, and industry. We don't have balance sheets. We don't have income statements for the firms, but that would be very nice to have, and a lot of countries have that now. And then only 20% of firms borrow from multiple banks and allow us to implement these very granular firm time fixed effects. The vast majority of firms borrow from a single bank. By the way, this is exactly the same in the US. Exactly the same percentages. Most firms borrow from a single bank, contrary to what people tend to believe about the US. And finally, we have a lot of additional data we bring to bear. So how do we set up our empirical work? We're guided by two sets of hypotheses. On the one hand, bank lending channel transmission should be very straightforward. We will look at whether an increase in interest rates reduces the probability of accepting new loan applications, loan granting, reduces loan volumes and increases the price on granted loans. And then we're going to test the bank balance sheet channel, which will identify differential effects for banks with different levels of capital and liquidity. So how should we think about this bank balance sheet channel? In general, healthier banks, and by healthier banks, I'm gonna mean banks that are better capitalized with more liquidity, yeah. By liquidity, I mean higher holdings of liquid instruments. We think of those as treasury government securities, yeah. Those banks, healthier banks, should attract a relatively lower cost of funding when there's a tightening of monetary policy. So they should be less responsive to a tightening. In developing countries, however, bank liquidity is typically just securities, and holding very large amounts of securities may reflect a preference for government securities, so a business model that is maybe more connected politically, and moral suasion, being subject to moral suasion, which suggests crowding out of private lending. So the effects may be different in developing countries, and we will see that they are indeed just like that. So I'm going to show you three main tables, and I'm going to run through them because I've given you the story already. I'm going to run through them fairly quickly. Here's the impact of changes in interest rates on the probability of loan granting. All of this is loan level data, and I'm plugging in here all those fixed effects that I mentioned in order to identify loan supply effects. So we see that an increase in interest rates reduces the probability of loan granting. The first three columns show a negative coefficient. That this effect is stronger for high liquidity banks and dampened for high capital banks. Yeah, so just consistent with the hypothesis I put forward earlier, that healthier banks, better capitalized banks, do not react as much to an increase in tightening of interest rates because they do not suffer a commensurate, they suffer a disproportionately smaller increase in their cost of funds compared to highly liquid banks. By contrast, highly liquid banks that are loaded with government securities react even more to a tightening of interest rates. They just load up even more on government securities, which crowds out private lending. So the private lending suffers. And these two effects are going to be coming back over and over again in the next tables. So one standard, I want to give you this one economic quantification of the results because I can compare it with an advanced economy to see how it compares. A one standard deviation on increase in interest rates, which in our case is 359 basis points, reduces the likelihood of loan granting by between 1.2 and 2.8 percentage points. And the same impact is achieved in Spain. I mentioned the AER and the Econometrica papers. They have the same estimate. That impact is achieved in Spain with an increase in short-term rates of only 100 basis points. So you need basically almost 4 times as large jump in interest rates in order to deliver the same extensive margin adjustment, lending adjustment by banks. On the intensive margin, loan amounts, now the dependent variable is loan amounts. Loan amounts decrease with the tightening of interest rates, especially if the banks are for banks that are highly liquid and less so for banks that are highly capitalized. More importantly, what happens to lending rates? We see them respond. Lending rates go up by between 33 basis points and 48 basis points, which is not bad for a 100 basis point increase in the policy rate, in the short-term interbank rate. We have almost half of that is passed through to the lending rate. Yeah, so this is strong transmission. It's as strong as for European countries, 50 basis points, so half. Again, stronger transmission by 2 to 3 basis points for highly liquid banks and weaker transmission for highly capitalized banks. Okay, good. So now, if I have 2 minutes left, do I have 1.5? 2 minutes left. Let me quickly run through the real effects. So I promised this cool data from satellite luminosity, which is very amply used in developing economics. By the way, we use it for the US as well when we want very, very granular understanding of what's happening to industrial production, because we don't have statistics. Not only that, we don't have that many statistics, but we don't have very, very high frequency statistics. So you want to know what's happening now, you go and read the satellites. And this is what the satellites are telling us, that growth across districts was sort of overheating. We see those red areas. As the tightening happens, we see a chilling, a cooling down of economic growth, and there is somewhat of a recovery as the central bank eases again in 2012. So this will translate in terms of regressions very nicely across multiple indicators of real activity. So if we look at building permits, so first of all, I'm gonna just take a step back. You see, I'm not putting in these regressions the interest rate by itself anymore. And one reason is that it's again very difficult to identify the effect, and we wanted to be a little bit more cautious. Differential effects are a bit more believable in real effects regressions than level effects. So we just showed the differential effects here. So in areas where banks have a lot of capital, we see that building permits pick up less. Whereas in areas where banks hold a lot of liquidity, treasury, government securities, building permits pick up more. So the same effects we saw across banks in loan level data, we see them now across districts in real effects data, in aggregate administrative unit level data. And the way we calculate capital and liquidity at the district level, because we have it at the bank level, of course, is for every single district, we see the market shares of all the banks, and we take a weighted average of their liquidity ratios and capital ratios within the district. And that's how well capitalized or liquid the district is. We see export volumes dampening the effect, export volumes reacting less for highly capitalized areas. Similarly, we see night lights responding after 3 or 4 quarters. Again, less so for highly capitalized banks and more so for highly liquid districts. And finally, we see also impacts on inflation. We see impacts on inflation up to a lag of 12 quarters. So this was the first comprehensive analysis of the domestic bank lending channel using administrative microdata, absolutely beautiful data from Uganda. And I also know Rwanda has equally beautiful data. And I have not seen a bank lending channel analysis, so I know we have somebody from Rwanda. Exactly. This is, I hope, an opportunity to think about that. We see strong transmission, especially the pass-through to lending rates is about 0.5%, 50% of the increase in interest rates. So it's very meaningful. And then I haven't shown you this. Maybe it's going to come up in the Q&A as well. Is it true that in financially repressed areas, in areas that are less financially developed, we see lesser transmission? And we use variation in financial development across districts within Uganda, so holding the institutional context, legal context, macroeconomic context constant. And we see that that variation delivers exactly that message. Where we have more financial development in the sense of more bank branches, transmission of monetary policy is stronger within Uganda. Thank you.
There you go. Well, thanks, Camelia. That was really, really interesting. And whenever I see a paper like this that uses credit registry data, I'm always so jealous that we don't have this kind of data for the US. We have the call report data, but that isn't matched with loans. There's deal scan, but it's highly incomplete. So way to go. So we do have about 10 minutes for questions or comments. Let's start with one more question, Professor.
Good morning. Thank you very much for your presentation. I am Nur Sultan from Kyrgyzstan. So I have a question. Like you said that the banks with strong balance sheets, they do not react the central bank's policy. And what is the reason behind this? Because maybe, I mean, the households in Uganda, they are not informed about the central bank's policy, or these banks, they are sure that households, they do not change their mind and they will not go to other commercial banks to get credit. And what is the problem here? Maybe central bank do not communicate with the people well, or people are not aware about the monetary policy when central bank changed its monetary, policy rate. households, maybe, I don't know, maybe they don't have any knowledge about the central bank's policy? Thank you.
Very good. So excellent question. Yes, absolutely. So let me focus on capital as a measure of bank balance sheet strength. So the argument is that banks, like firms, benefit from an external finance premium because they are externally funded with local deposits, some market funds, in many places by interbank funds as well. So there's not much reliance on wholesale funding here, but it's mostly deposits and interbank funding. And the argument is that a stronger balance sheet will allow market participants, including depositors, to accept a smaller interest rates. When interest rates increase, they will accept a smaller interest rate from a highly capitalized bank than from a lowly capitalized bank, because that bank is just more stable. So they're willing, the pass-through to the cost of funds for that bank is going to be a little bit smaller than it is for, it's just a differential effect relative to a weaker, less capitalized bank. Another argument is, so I think that this is the overarching argument why a strong balance sheet need not react as much to tightening of interest rates than a weaker one. In addition, if you have more capital, it means you have more loanable funds. So you can afford to continue taking advantage of whatever investment or lending opportunities you have as a bank, because you just have more money ready to deploy. You're not going to be as cautious. You're not as constrained. A constrained bank will react more to an easing or a tightening of its budget constraint simply because it is more constrained. And so a less constrained bank will do so less. That's why highly capitalized banks are less sensitive to the transmission of interest rate policy.
We're going to go to the CDE fellows first.
Okay. Thank you. Good morning. My name is Sampho from Cambodia. So I have a question regarding, as you said that the highly capitalized bank is less reactive than the highly liquid bank. So my question is that, is it only tied only to the bank that hold a lot of government security? And how about like in the context that the country that the government security don't really work? For example, like in Cambodia, the government security don't really work. Most of the bank, they just hold the reserve requirement in the central bank. So in that kind of case, do you think it's still working? Like, is it still affect the tightening of the interest rate effect, or it's more like become the highly capitalized one?
Yeah. So I mean, reserves are like cash. You can deploy them.
Yes, yes.
So I don't know for sure, but so I don't know what we would find, and it would be interesting to explore what you find in the particular case of Cambodia. I would say that there's liquidity and liquidity, right? So liquidity in government in developing countries is about holding a lot of government securities, and those government securities are a very safe kind of investment. I don't want to use the word lazy banks, but lending is very difficult. Lending means that you have to pay the loan officers, you have to do the market research, identify worthy borrowers, select them, monitor them. So that's a lot of work. Investment in government securities is easy. You just purchase them and then you get the return. So holding a lot of government security is also a form of like financial depression when your banking sector is basically funding the government. Sometimes it's also directly lending to the government. So this is why we think that we find these negative effects here, that it's almost like a business model. These banks, I think of them as lazy. The banks with a lot of government securities are sort of lazy banks that prefer to just invest in safe assets that do pay a return than to do the hard work of lending. And so they are the ones that are very reactive to monetary policy in the sense that they contract a lot more lending to the private sector because they just can park when interest rates increase. And so the return on government securities, they will just park that money in government securities than do the hard work of lending. So I think it would be interesting to explore your question. I don't know what we would find.
Roberto.
Thank you. Fascinating talk. But there was a word that was absent from the whole talk, which is exchange rates. I mean, is there any role for exchange rates, and can you do something to empirically to figure out what the role is?
Yeah, so on the exchange rate, we try to stay away from that aspect. We just kind of control for it. So we control for it in I don't have it here. In the regressions, we let that channel. So Uganda has a flexible exchange rate regime over the period. There's the exchange rate certainly absorbs some of the effects, and so we try to show that all of the causal effects that we identify, hopefully they are causal, go through even when we allow the exchange rate to, we control for the movements in exchange rate. Yeah, yeah.
JJ.
Yeah. Thank you very much. I'm Jean-Joël Kwame from Ivory Coast. I was wondering, like, the transmission mechanism, how did you control for the bureaucracy in the banks? Because we could expect, like, if as we are in a developing countries, banks are not that risk averse because the economy itself is not that certain. So how did you control for the time for the bank to actually analyze the loan it has to give? Thank you.
Yeah, so all of these effects allow for like a 1/4 lag. We allow for a 1/4 lag. When we look at the real effects, we allow for much longer lags. We see loans in the pipeline typically up to 3 months or so. The underwriting process, at least in the US, takes about between 30 and 90 days for a completely new loan. So we think that that's kind of the normal lag to a decision relative to when some changes in interest rates happen. Banks also post new retail rates weekly. I honestly do not know exactly how things were being done in Uganda, like on the ground. When it comes to any specificities related to the banks themselves and how they do their lending and the ability to kind of ramp up in terms of do they have the right staff or the ability to kind of wind down their lending, we have bank fixed effects and we try to capture some of that with these dummies. Yeah. But in terms of lag, so we allow for 1/4 lag for the lending effects, and between most effects kick in after 4 for the real economy, and for inflation we see effects up to 12 lags.
I'm going to go to Professor Uras here. And maybe this might be the last.
Great presentation, very inspiring talk. One question I had was about the business model of banks, which may also be changing over time. And one aspect in the context of developing countries, and perhaps also in developed countries, is that in relationship lending matters a lot, especially when extending loans to uncollateralized individuals or firms. Have you thought about developing a measure of relationship lending and how that will interact? Yeah.
That's a great question. No, I think one reason we didn't do that, so there's definitely a lot of relationship banking going on here because 80% of firms are just banking with one bank. I think maybe the ones that have multiple banks tend to be maybe exporters, just larger firms. We don't have information on collateral, but I think more importantly to your question, we wish we had like a longer credit registry so we can observe these relationships over a longer period of time. So then we would maybe get a measure of like the duration of the relationship or maybe the extent of the bank's exposure to the firm, like how exposed is the bank. That's another measure of relationship banking. And it would be interesting to see if some of these effects are maybe muted for a relationship borrower. You would imagine that, if banks price the entire business relationship, not only the loan itself, but maybe multiple products that it offers to the borrower, some of the effects would be dampened. I think there's actually some recent evidence from Norway suggesting that relationship lending dampens the effects of interest rate changes.
Well, I know we could spend the better part of the rest of the morning discussing this paper. This is really, really